and welcome back to Economics in One Lesson in the 21st Century, the channel where I show you a straightforward way to judge for yourself what other people are saying about economics. In this video, we're going to take a first look at what the One Lesson tells us about money and banking. This is a topic which has confused many economists over the centuries, including some present-day critics of the modern system of money. We'll start with two simple questions. First, what is money? And second, what makes it valuable? Whole books have been written about this, but the One Lesson makes these questions easy to answer. Remember, the One Lesson is, to understand economics, look at how each decision or action affects each person's net worth. We can actually use the same answer for both of our questions. Money is a debt owed by a bank to the holder of the money. It's in the form of a banknote or an entry in a bank account. It answers the question of why money is valuable because debts increase the net worth of the creditor, and of course also decrease the net worth of the debtor, in this case the bank. There are actually other kinds of money, although they're only a small proportion of the total money in existence. Some money is a debt owed by the government to the holder of the money, such as United States notes, as opposed to the usual Federal Reserve notes in the USA. Commodity money is in the form of a tangible asset, such as a gold or silver coin. That's valuable simply because it's a tangible asset, and it can be treated just like any other tangible asset. Cryptocurrencies, such as Bitcoin, are a curious alternative. They aren't debts or tangible assets, and can't be considered as adding anything to the holder's net worth. They need a video of their own. In this video, we'll look at where most money comes from, how it's used, and where it ends up. Most money is created when a bank creates a new debt owed to someone else. Maybe you find this surprising, or maybe it's old news to you now. I first learned about banks creating most of our money in early 2008 when I watched the short animated film Money as Debt by Paul Grignon. It claimed that the whole monetary system is a fraudulent way for bankers to extract wealth from the rest of the world. In fact, watching that film was what started me on studying economics in depth, which eventually led me to discover the One Lesson. The film's worth watching because it encourages the viewer to ask questions which might not have occurred to them. But the One Lesson quickly shows why I came to some very different conclusions. For a start, money is a debt owed by the bank to the holder of the money. Writing IOUs to other people is not a quick way for banks to get rich. So why do banks create new money, reducing their net worth in the process? The answer is very simple. They get a transfer of net worth in exchange. Here's an example of how it normally works. By the way, whenever you're looking at one of these scenarios, always ask yourself if you think everybody is satisfied with each of the transactions. Banks create money when they make a loan. Here, Bob asks Megabank for a £10,000 loan to buy a car. Megabank creates £10,000 of new money for Bob, and in exchange, Bob promises to repay Megabank £10,000 after 5 years. To keep things simpler for now, I'll leave the topic of interest for another video. So, Megabank creates a new debt of £10,000 to Bob, and Bob creates a new debt of £10,000 to Megabank. Each person's net worth decreases by £10,000, and also increases by £10,000. So in total, neither person's net worth changes at all. You may be wondering what the point of Bob borrowing £10,000 is, since it doesn't seem to have any effect. I'll come to that later. For now, Bob buys a car from someone by writing a cheque to the seller, which transfers a £10,000 debt asset from Bob to the seller. Megabank is still the debtor. For this scenario, I've lumped everyone in the world apart from Megabank and Bob into one huge group and labelled them etc. to mean the rest of the world. So, when Bob buys a car, his net worth increases by the car minus £10,000, and the rest of the world's net worth increases by £10,000 minus the car. Eventually, Bob has to pay his debt to Megabank. To do this, he needs £10,000 of money. Two possibilities are him stealing it from someone, or someone giving him the money as a gift, either of which would be a transfer of £10,000 from the rest of the world to Bob. But more likely, he'll have to give something in return for the money, either selling something he already has, or producing and selling a tangible asset or a service. Let's say he works for an employer for 6 months and is paid £10,000 for it. So, Bob has provided a service for the rest of the world, and the rest of the world has transferred a debt asset of £10,000 owed by Megabank to Bob. At this point, Bob owes £10,000 to Megabank, and Megabank owes £10,000 to Bob, exactly like immediately after Bob received the loan. When Bob repays his loan to Megabank, each person transfers £10,000 of net worth to the other by writing off the debts. This undoes the first step in the lending process, where Bob and Megabank created new debts to each other. The money created when Bob borrowed it has now been destroyed. In total, over the 8 economic actions, Bob has put in the effort to provide a service of 6 months' work, but his net worth has increased by the car. The rest of the world's net worth has decreased by the car, but it has benefited from Bob's service of 6 months' work. And the bank has ended up exactly where it started. The 6 of the 8 actions in the scenario which transfer £10,000 of net worth end up cancelling each other out. This might seem to be a very roundabout way for Bob to exchange his work for a car, but money provides a lot of flexibility to the process of buying and selling. Consider an alternative. In principle, Bob doesn't need Megabank's IOU to buy a car. He could just write his own IOU to the car seller, and someone could later use that IOU to pay Bob for his work. There are lots of problems with that system, though. Most people probably don't know who Bob is, and more importantly, whether they can trust him to keep his promise. Megabank, on the other hand, if it's well known and well run, is more likely to be trusted by people to keep its promises to pay, so its IOUs are more generally accepted by people as payment, meaning that those IOUs are essentially money in a way that Bob's personal IOUs never can be. Megabank will still owe a debt to whoever has the money, even if Bob fails to pay his debt to Megabank. Another problem with Bob writing his own IOU is the unimaginable difficulty of coordination which it would need to get Bob's IOU from the car seller to the person who wants to employ him. With money, it doesn't matter whether the £10,000 paid by the employer to Bob is the same £10,000 as Bob used to buy the car. All that matters is that the amount is the same. There's a technical term for this. Money owed by the same debtor is fungible. Loans are a common scenario where banks create money, but there are others. Some of the most important are where banks pay employees for their work, pay suppliers for their goods and services, buy investments such as shares, pay dividends to the bank's owners when the bank makes a profit, and take deposits of cash. Cash is a debt asset owed by a central bank to the holder. When a customer deposits the cash at a bank, the customer transfers this debt asset to the bank, and the bank creates a new debt owed to the customer. So, that's a brief overview of modern money. What I hope the one lesson shows is that there's nothing particularly special about it. It's just a debt asset which people generally accept as a fair exchange for a transfer of net worth in the opposite direction. The most unusual thing about money these days is that it's a debt for something which can't ever be delivered by the debtor to the creditor, because pounds, dollars, euros, yen, etc. are abstract things which don't exist as tangible assets. Instead, the person with the money writes off the debt in exchange for a different type of transfer of net worth. 2 types are particularly common. First, as we've seen, is repaying a loan. Both the bank and the holder of the money write off the debts which each owes the other. Second is a withdrawal. The bank transfers cash, a debt asset owed by the central bank, to the holder of the money. Some people clearly feel uneasy about debt-based money, but I hope this video makes it clear that the bank which issues the money is not getting something for nothing. The holder of the money is still owed the debt until they receive something acceptable in exchange. In a future video, we'll look at the subject of legal tender, which is something that the creditor has to accept. Given that there are no tangible pounds, there's a very interesting question as to how much a pound is worth. There's a quick answer, which is that it's worth whatever someone is prepared to exchange for it, but the longer answer, where we need to think about inflation and deflation, is a very subtle one, which needs at least a video of its own. Okay, thanks for watching. If you appreciated this video, please share, like and subscribe, and please leave any comments below if you found it useful or if you have any questions. I'll see you soon for more economics in one lesson in the 21st century.